I'd like to introduce our panelists today. With us today, we have Maria Grace, who's the Chief Underwriting Officer for Property and Inland Marine at Everest Re. We also have Michael Chang, the CEO of Global Risk Solutions at Sampo. Sanjay Gidwani, the EVP, Head of Property at BH Specialty Insurance, and Duncan Ellis, the Head of Retail Property at AIG. So we have a short and probably a quick 35-minute discussion today on the property market, what's going on. 2020, we've witnessed a year of a record number of named storms. We've got wildfires, hail claims, tornado claims, civil and riot commotion claims, some really large per risk fires and water damage claims, and an ongoing global pandemic. So overall, a pretty lousy year that no doubt all of us are excited to see come to an end. So with the above in mind, that in mind, we're now going on, almost 12 straight quarters of a market where we've been seeing rates rise and coverage restrictions. When I think about this market cycle and I compare it to, say, the mid-'80s or after 9/11 or even after 2006 with Katrina, Rita, and Wilma, those market cycles were, lasted no longer than, say, 18 months. So my question, and I'd ask, Michael and Sanjay to perhaps comment on this. What's different? When I think about this market and going on 36 months of change, what's different this time around? Michael, we'll start with you.
Yeah, first off, thank you to Marsh for hosting again a nice global real estate conference. And a special shout out to all the clients that are out there. To your question, it's been challenging for us as underwriters. And what I equate it to is a little bit of golf and that a bogey that keeps moving. You've had a lot of events that have continued to happen, which has really affected the way that we look at technical price. Technical price that you saw in 2012 to 2016, when there wasn't really many cat events to talk about, or convective storms, was at a historic low. What you found through starting in 2017 forward is that there was a lot of change. Regardless of your political persuasion, climate change is real. It really is for us as an underwriting community and at Sampo Global Risk Solutions. So when we look at the events that have happened, whether it's the named windstorms, Sarah, Laura, Delta, or you look at a lot of the convective storms that have happened, tornadoes in Nashville, you've seen the derecho. And then you sort of couple that with events like the unfortunate events that happened in Minnesota and the civil unrest that happened as a result of that. And then you also look at some of the other types of events like COVID. It really has changed the way that you've had to look at pricing. And it's been this way for the last couple of years, 3 to 4 years. So pricing has had to evolve, where when you have set a price before, and rightfully so, based on the conditions and events, those events over the last 3 to 4 years have heightened. And it looks like for us as an underwriting community, we're continuing to chase and catch up with the price. So I think when I look at what happened in those previous events, it was one and done. This is more of a continuous shift on how you've seen events and where you sort of need to price this events. The other thing I would just close with saying on that is, I look at insurance as the capital lending business. We lend capital and we intend to make a fair return. No different than the real estate business. A lot of the clients that are out there, they look at the operating income of an asset and they want to make a return on that individual asset and then on their portfolio. It really is no different when you look at the two business models, right? We put capital out, we need to make a fair return on that capital.
Thanks, Mike. Sanjay?
Hey, first of all, thanks for having us, Ryan, and to everyone at Marsh. Wish we could be with the customers. Obviously, this is quite different, right? Hey, I'd only add a few points to what Michael said. First of all, I think the reaction or the response by the market is more moderated this time in an annual basis, okay? Not maybe moderated on a cumulative basis. And I think every customer is having a different sort of a reaction from carriers. But I think it's driven mostly because we're shooting for adequacy. It's not about capacity. I mean, we're still competing. right, for business. I don't win a lot of the business I quote at BHSI. So competition is there. It's just what's the right price. And I'll give you an example or two, right? We have at BHSI about 50% of our aggregate for hurricane unused at this point. We could deploy it, but we don't think the pricing's right. And if you think back over the last 3 or 4 years, rates were probably down, I don't know, give or take 30 to 40%. At 15% rate increases, it takes 3 to 4 years to make up a 40% rate deficiency. So unfortunately, it takes time when it's moderated, and I think it has to accumulate. And the last thing is to play off what Michael said. Unfortunately, the loss activity hasn't moderated at all. If we had gone through a quiet period, it probably would have influenced the market, but we didn't go through a quiet period.
Yeah. So Maria, Michael mentioned climate change, and regardless of your views in the world, I think in the insurance industry, we all recognize that it's influencing things. How is climate change impacting the way that you guys at Everstreet think about risk, price for risk, underwrite risk? And do you think there's at a certain point, certain risks will become, in fact, uninsurable?
So thank you, everyone. Thank you, Marsh, and the clients for taking the time to, meet us today, even if it's virtually and not in person. It is a reality. It is what it is. We can measure it. We can see how the gradual deterioration of the environment has affected our industry, our lives. Every year there is a higher frequency and more severe events. So we cannot deny it. And if a carrier, 2 decades ago or a decade ago was thinking, okay, we're going to pay one major CAT event every 3 years. Now it's become, we have multiple CAT events every year for multiple years in a row. So at this point, while there is an appetite for the volatility that comes with, CAT catastrophe events, I think that appetite for volatility is finite. It's not, it's not going to come at a very cheap price. It's not going to come from everyone. So I think that it will definitely affect the pricing if our loss expectancies are going up the way they are because the environment is changing and the destruction is coming in the ways that we have seen it. Then, in order to deploy the capacity, we're going to need, to get adequate returns that are commensurate with the risk that is being transferred. So it's definitely affecting pricing. I think the view of the traditional, the perspective of what constitutes a CAT, a traditional view of hurricane and earthquake is no longer the only thing that we look at as CAT, right? We have inland flooding, which has been one of the, the lead causes of losses for carriers. We have obviously wildfires, you mentioned, hail, tornadoes, straight line wind in Iowa, that we saw basically hurricane force winds in the middle of the country. So all these events, we can't ignore it, we have an obligation with our clients, with our shareholders to make sure that we are financially stable, that we are producing the returns that they need to make the insurance be sustainable. Now, do I think that that eventually will be uninsurable? I don't think so. I don't think that individual risks are going to be uninsurable. I think that is, like Sanjay mentioned, it's a matter of pricing. It has to be the right price. There could be that at the end of the day, clients decide to not insure certain perils because the price is such that they might just decide to self-insure. But I don't think that is because the industry itself is going to then classify something as uninsurable.
So it sounds as if everyone's in agreement that, this market right now, if I think about other times where the market became more difficult, we're not dealing with a capital, or capacity issue. It sounds like it's a profitability issue. And if that's the case, Duncan, maybe if you would comment on what do you think the change, what needs to happen in order for the P&C industry to have long-term sustained profitability and stability?
Yeah, thanks, Ryan. I do appreciate it. And again, last but not least, thank you to Marsh and all of the clients in real estate and hospitality listening into this. Really appreciate it. Yeah, and not to be repetitive on what is said, right? So obviously the loss costs need to come down. And we've got an incredible amount of assets now piled up in CAT-prone areas, coastlines, earthquake zones, flood zones, et cetera, et cetera. So from a loss perspective, we need to manage that.
Okay, looks like we may be having a little bit of, I thought I froze, so I'm glad I'm not the one that froze. Maybe having a little difficulty with Duncan. I'm gonna pivot then. Michael, you mentioned,
I think it's really a matter of getting diversity on the book as well. I mean, Maria said the same.
Brian, so let me just jump in and I think it's obviously the rate adequacy. It's a big issue. I think that controlling attritional loss ratios, for a company, that's kind of like the one thing that we can control. There's no way that we can control CATs from happening, right? But I think we do have the ability to control our attritional loss ratios. So that, and combined with management of expenses, that is another important factor in making a book be profitable.
Yeah. So Michael, you mentioned previously about technical pricing and the need for that to move in line with the losses as they're developing. Having gone now through almost 12 quarters of rate, would you comment on where you think pricing is today? Are we approaching adequate levels? So maybe ask you to comment on that, and Sanjay, any comments you have on that. And Dunk, just so you're aware, we were having a little bit of pausing with your internet connection there. So if somebody starts talking, it's because you've frozen up a little bit.
All right, not to worry.
Okay.
Yeah, I think that when you look at the business and rate adequacy, if you told me 12 months ago, I would have told you by now we would have been rate adequate, right? And we're on our way. So pricing has clearly improved for the risk. But again, it goes back to the comments I was saying earlier. That bogey continues to move. So I think the challenge is going to be, can you catch up to where the events have gone to get to that adequate state, right? And once it gets to that point, you can say you're rate adequate for your book and you're comfortable with any of the events that have happened. Again, I think you got to look at, no different than casualty business, because I oversee casualty business as well. It's like loss picking your business, right? And based on the events for the last 3 to 4 years, I would have assumed we were there, but then some more things happened this year that sort of raised that bar again. We're almost there. I mean, I don't think that, and I feel for the clients, I really do, because now it's been 3 successive years of increases. And I wish I can say to them, each and every one of them, hey, look, the brakes are on, we're at the right place. But we can't control the events that are happening, either from a climate standpoint or some of these other types of events, as I mentioned, like the Minneapolis events that led to the civil unrest, or again, COVID-19.
Yeah. Sanjay, you're on mute, bud.
I'm going to differentiate here, right? So I'm going to speak to our book first and then the market, and I'll make it quick. I think in general, we would characterize the book of business we write at BHSI and property as adequate. Okay, we're at technical. There is one issue related to that Michael said, which is, unfortunately, there are losses that are occurring that we didn't contemplate. So we're not redundant. We can't pick up sort of the aggravation that's occurred from things we didn't contemplate. We did not allocate dollars for riot and civil commotion. We just didn't. I don't think the industry did. We weren't alone on that. So that's an area where, that's become at least something we took on from a law standpoint, that, we needed that funding for other things. We're in a loss position through through 3 quarters of this year. So, that's not a great outcome given, even if you are at adequate, you can still lose money. And so that's where we are through 3 quarters. I think in the end, though, even if I tell you we're adequate or technical at a portfolio level, hey, every account's still going to be a bit different, right? There's some that are more adequate than others. There's some, and it does come down to peril, where your risk located, and then valuation. Not every account has the same sort of, in our mindset, strong values, and those things will play out too.
Yeah. Okay.
One other thing, Ryan, when it comes to the overall market, though, I don't feel that way. I think there are lots of accounts that, at least in our view, aren't there yet that we're not currently participating on.
Yeah. So let me ask you a couple of questions that have come in from clients, right? And as the market has focused on, your books and returning to profitability, I think sometimes there's a perception that, a lot of authority's been taken out of the field and that we're dealing with longer referral process, and decisions are being taken to the home office as books are trying to be, corrected. And, our clients spend a lot of time dealing with their underwriters and building those relationships, and want to be candidly dealing with decision makers. So how do you battle that perception right now that there's less authority in the field, maybe clients feeling there's less importance on relationships, or that the accounts are being differentiated? So Duncan, can you comment on that?
Yeah, sure. So hopefully you can hear me this time. My apologies if I became that sort of underwater voice as you talk about, Ryan. So sorry about that. Look, I agree. And again, if you didn't get my thanks out before, thank you to Marsh and the real estate clients for putting this on. But look, I think, from like what Sanjay said before, I'll talk a little bit about AIG specifically because, I can't speak to the other markets, but AIG had a profitability issue, a massive profitability issue. Was just so overloaded in certain areas and underloaded or underrepresented in other areas. And it was almost what Maria was saying about coastal properties, right? You need some diversity within your book. I need a little bit of coastal, I need a little bit of this, a little bit of that. You need that diversity. And then many times we just didn't have that, right? But that said, relative to what was going on in the field, I can safely say at AIG, there was a lot of capacity or authority which was pulled back from the field because there wasn't really that much consistency of what was going on. There was inconsistent decisions being made in this office as opposed to another office. So we basically pulled that capacity or the authority back. We built out the line guides, we built out the occupancy guides, we built out the line setting guides, all of which we have now rolled back out into the field. So it's very clear now what the field can and can't do. And I get it, right? The referral process is a little painful. I'm not going to deny that. It is. But that said, we are speeding that up, at least within AIG we are. We are putting a lot of authority back out into the field, which is a good thing. And again, just to comment, if I could, on technical, that is but a marker on the book, right? It really is. It's just, we have tons of accounts which are above technical, but also a number of accounts which are below technical. Sometimes those which are below technical because they just run better. They just do. And there's other accounts which are above technical because sometimes they're just snake bit, right? No matter what, every year there's something else that happens, even though they're at technical. So basically, from our perspective, hopefully you will see, a significant improvement in the field. And we have been very clear in the field as to what they can and what they can't do. And a lot of the authority levels coming up to CUO approval, we're looking to limit that number substantially.
Okay, thanks. So some more questions coming in from the audience, which is great. So I'm going to pivot to those. We've talked a lot about pricing, and Sanjay, you've said some accounts are at technical and rate adequate, and some others aren't. And I guess as we or as you perceive that pricing on certain accounts is improving to a point that you feel it's adequate, are there opportunities for long-term deals, right? A lot of our clients who have static portfolios that don't really change a lot year to year, we do this annual dance. And when the market was a little easier, we had a lot of deals in multi-year deals, and clients really liked that. It was efficient, it was stable, it was predictable. Are we getting to a point, and Maria and Sanjay, maybe if you'd comment, where the market will consider multi-year deals again?
Do you want to go first, or you want me to go first?
You go for it.
Okay. Thank you, Maria. So I'd say in general, Ryan, we haven't actually stopped doing long-term deals. We never did. If I go back 2 or 3 years, the makeup of our book was about 10% policy count was 2 to 4 year term, and about 30% of our premium. It's the same today. The difference that hasn't grown because I think customers have not been comfortable buying a long-term deal in the last year or two, even if we offered it, right? They're trying to figure out where the market is. We're absolutely in a position to want to do it. It does come down to the risk. It comes down to, is it single peril? That's easier, right? And is it a peril that we feel comfortable, we understand well? Is the risk profile relatively stagnant? Is there not lots of ins and outs and growth? And then how comfortable we are at the peril. We're not going to do a long-term deal on probably a severe storm, hail exposed account, but we do a long-term deal on an earthquake exposed account or a hurricane exposed account. So peril is going to matter, makeup of the account and the quality of the assets. And yes, we are interested in doing more of them for the right customer.
Yeah.
Agree with that. Like we're in the same position. Like Everest is a stable carrier. It's a stable capacity. We are a cut writer. We understand the risk. So there is nothing that would preclude us from deploying the capacity on a long-term basis. I think that the issue becomes, are both parties going to kind of hold to their agreement, right? That if it's a long-term agreement, everyone has to stick to it. And it cannot be a one-sided agreement. And I think that the problem that we have seen over many, many years is that the moment the market starts to soften, or terms and conditions start to relax again, rates start to maybe go down, then clients decide to pull back and not honor those agreements that we've made, with the carriers. So I think that's something that it has caused the carriers to be a little skeptical of long-term agreements, because we've seen it. But I think that for the right partner that is willing to really commit to a long-term relationship with their carriers, absolutely, the options are there. That we're not changing appetite, we're not re-underwriting the book. Our book as it's built today is what we like. It's fantastic. Just like Sanjay said, this, we feel very comfortable with where we are and who our clients are. So there's no reason why we wouldn't, offer agreements that are more than just 12 months.
Okay. So we've got about 10 minutes left, and we've talked a lot about the market and where things are and perhaps where they're going. But I want to pivot to maybe some of the solutions, right? What can our clients be doing in this market? Maybe Michael and Maria, again, if you would, can you talk about some of the strategies that you've been seeing some of our clients use that are perhaps non-traditional in terms of just buying pure risk transfer, but what alternatives do you see clients utilizing, whether it's in, any subsector of real estate or in multifamily or hospitality, to try and manage their total cost of risk? So Mike.
I'll take a stab at that for sure. We've offered what's called integrated and structured programs. So integrated is where you blend first-party lines with third-party lines, and structured is where you deal with either first-party or third-party through an aggregate retention on the property. And we've done over 250 of these deals. And I still remember when we originally started doing, people like, we can't take it because of allocation issues, because of loan covenants, because of our tenants. And we've gotten through all of that. I'm proud to say we've led the charge in the marketplace doing these. We've done a significant amount of them today. We've dealt with whether it's a fiduciary or real estate fund manager, whether it's a real estate firm, a hotel owner, operator, a global real estate service firm, a property manager. We've had examples on every single one of those categories where they've been able to do these funding mechanisms. And at the end of the day, if I'm the buyer, I would sit there and say, especially on our integrated program where we blend property and casualty, because 85% of our clients, we do more than one line of business, right? There's no downside to you. Why wouldn't you take it? In a great year, you're going to get money back compared to a straight program where you would do your normal deductibles on property and first dollar on casualty. It's basically the same, but in this case, you get the chance of a return with no downside. And that's what customers are seeing, and they like it because now they're into the game like we are to make sure that they control losses and control risk so that they can get that carrot back at the end and get some money back. So we are pushing something that's unique, it's different. We're going to continue to drive it. And I really believe when we look at some of our clients and brokers and agents out there like Marsh, some brokers and agents like at Marsh are just selling that as an option. So it has worked. So I would just say to those clients, if you haven't talked to us about it, you should, because it's something that has gained a lot of traction in the marketplace.
Maria, other comments on strategies, perhaps captives,
Yeah.
things like that.
So I think that any structure that is going to alleviate attritional loss for any carrier is going to be very attractive, right? So I think that anything that you can do to change the way how the risk is perceived by the carrier on a frequency issue, I think is going to be welcome. So higher retentions. I think that the retentions should be a reflection of the financial stability of your business. So the worlds of 10,000 deductibles when you have billions and billions in assets, doesn't, like it doesn't really reflect that. So I think that taking higher retentions, utilizing captives that you have in place to, to then maybe add on to a retention level, aggregate deductibles that are going to help control the frequency of attritional losses is definitely going to have a positive impact on the pricing of your program. I think there's more things that clients honestly should be doing. Nobody knows your business better than yourself. I think that sometimes when we receive a submission, for example, that story doesn't make it to our desk. We don't have complete submissions. We don't have detailed information about continuing, like what is your contingency planning? Are you using technology-based tools to collect data, to enhance the data that you provide to the underwriters? But what's going on with your loss prevention? Like, are you suffering, because the revenue is down? Does that mean that the capital expenditures on loss prevention are suffering as well? Or maybe you decided to just not go forward with some cosmetic changes that you were going to make to your properties. I think all these little things matter. And it's, like the submission, the quality of the submission is paramount. And I think it's important that the clients walk out of, this conference thinking we need to, more is better. Transparency, more information to underwriters is better. Higher retentions is better. All these things will definitely affect the pricing.
Yeah. Okay, great. Thank you, Maria. Duncan, I'm going to ask you, we got about a minute and a half left here. What things, Maria started to mention some of them, but what things in this market specifically, and I'm not talking just data or secondary characteristics, but what things can clients be doing right now to differentiate their risk to you guys, to make their risk more attractive, to increase the probability of a big line size at fair pricing?
Yeah, so, I mean, obviously I like to say this, and I've been using this, a couple of times. I just think the market is going to become, look, the rate uplifts can't continue into perpetuity, right? They just can't. At some point in time, you're going to see, rates flatten out. I know certainly we're seeing year over year over year. They're not at the same levels as they were. So you're going to see that flattening out. But I think the market is going to become a market of the haves and the have-nots, right? Those who have done geocoding and have addresses, those who have got the COPE information. It's remarkable to me, Ryan, how many times I see submissions come in and there really isn't that much information on there, which then takes a tremendous amount of time, which then drives down that sort of response time of ours. But the haves, i.e. the clients who have done that and the clients who have not done that. Also, I want to say this, it's share of wallet or sort of balance of trade, right? Are we being asked just to do the most difficult line and the good lines are going somewhere else? Or are we being asked to partner with that client on multiple lines of insurance? That is critical from our perspective.
Great, great. Well, guys, we're at the end of our time and I know everyone wants to stay on schedule. First off, thank you to all of the panelists for participating today. Continue to be kind to Marsh's clients as we navigate this market. And thank you for being with us all today.
Thank you.
Thank you, everyone.